Welcome back to the channel, and today we're talking GameStop and the rest of these short squeezes. Over the past few days, obviously you've been a part of the community watching GameStop go from $20 all the way up to nearly $400. Reddit community is taking Wall Street by storm, and the second question is, should you be getting in on these short squeezes? I'm going to give you my overall opinion on how I view this whole situation, and we're also going to hear from CNBC on an analyst going over what's happening with GameStop, why it's happening, and where they see it going in the next few months. Near the end of that video, they actually go over something very, very important, a new type of analysis he kind of makes a joke about, but it's actually something we should be paying attention to. Before we get to that content, I need you to do one thing and one thing only: hit the sub button down below, leave a thumbs up, and make sure you have the notifications turned on. I'm posting videos every single day about the trades that I am taking and the long-term stocks I'm also investing in. Let's not waste any more time. Let's get to it. The first thing we're going to do is watch this really quick video. It's about 4 minutes, so bear with me. You can skip ahead, but I do recommend watching at least the last 2 minutes of the video because this new flow analysis that they start talking about is actually pretty interesting.
Watching closely in these markets, namely, we're calling it the Reddit trade for lack of a better term, but certainly the focus on huge short positions that are in certain stocks and the decision to then go long those stocks to force those who are short to cover, squeezing them ever higher. This continues this morning in a crazy way. Bob Pisani, I want to bring you in. But, you know, I wonder as well as we watch an S&P now that's down 2%, and as I continue to hear from people that I'm speaking to of hedge funds that are under a great deal of pressure as a result of being short some of these names, and there are a lot of them now, and having to potentially sell their longs. I don't know to what extent, Bob, you think this is having an impact on the broader market, but it's not too hard to imagine that might not be the case.
Yeah, certainly hedge funds have positions. They're not just short stocks. They're long a book and they're short a book. And when you get the positions out of whack here, they have to maintain certain levels of longs and shorts, and they have to adjust their portfolios, and that can have ripple effects on the market. So, yes, I think it does. I think there's some broader things going on here that's not just that related. I think there's obviously some concerns. Earnings are good. If you look at Microsoft, it's not going to get any better than Microsoft. Their numbers were just simply fantastic across the board, yet it's up only 1% because it's moved up huge going into earnings. So we've got a problem here with stocks moving up in expectations of great earnings, and we're getting them, so it's hard to move the market forward. I think there's a little bit of that as well. As for the short story, and there you see Microsoft down here today. But remember, 117, a week ago in anticipation of earnings, it goes to 132 a few days ago, and now it's up there. So here's those heavily shorted stocks. And of course, as David mentioned, it's not just GameStop. We were talking all yesterday about all these names, including Tanger Factory Outlet and iRobot and companies like that. I think here's the question. What's different from the 1990s chat rooms? We spent a lot of time, David and I, in the chat rooms in the 1990s watching that. And there are some things that are very different from the 1990s. The information flow is very different. The ease with which you get information and get access to it, including on your cell phone, is different. The zero commissions are certainly different and may be a factor. The overall gamification of trading is different, that you can trade stocks like you do sports betting, which also didn't exist to this extent in the 1990s. You have to know that there's a difference. But then there's things that are not different, and I think that's very important to point out. The old-fashioned sense of greed, the whole herd behavior. There was a whole group of behavioral economics terms we all had to learn after the dot-com crash. We all got very familiar with concepts like herd behavior, which is the idea that we're all just going to move together. Confirmation bias, that investors kind of believe what they want to believe, what their biases want them to believe, and they just look for reasons to confirm that. The gambler's fallacies, that a series of wins are going to go on forever somehow, and you're never going to lose. And finally, loss aversion, something we all became familiar with, which is that the great weight of concern for losses, the concern for the weight of losses is much greater than from market gains. And we'll see if loss aversion becomes an issue in this story. It could well be. I think, David, the question here is there something really different here?
Well, yeah, it's kind of different. It's kind of different, Bob. No, I mean, in the sense of, you know, you referenced that period of time that we all remember quite well, and we've made certainly allusions to the late 90s. But I don't quite recall the focus on companies that had large short positions, certainly not larger cap companies that we're seeing now. I mean, you had a lot of small caps that moved. Typically, it was just on the buy side. I'm not quite sure we've seen anything quite like this. And by the way, the sums of money here are fairly significant. I mean, we talk about retail, but there's some people stepping up for some large options purchases here who have to put up a decent amount of capital to do that. Not to mention, I mean, somebody buying the 200 calls yesterday on GameStop that I guess were listed and now has made a fortune on them. There are things here that are unique.
Yes. The 1-2 punch of the ocean of liquidity provided by the Federal Reserve combined with that gamification of trading, combined with this strategy of buying out-of-the-money calls, has proven very effective. I'm talking about a broader philosophical issue, David.
Yeah.
I'm talking about the idea, which is, if you want to believe that GameStop's going to be $200 6 months from now, you have to basically believe that fundamental analysis doesn't really matter, that even technical analysis may not matter. Do you really believe that? So fundamental analysis based on the idea that there's an intrinsic value in its stock. And of course, as of now, this doesn't matter at all. Now, we know that this can not matter for short periods of time. I think it's highly debatable about whether suddenly we have discovered a new analysis, not fundamental, not technical, not quantitative, flow analysis, whatever you want to call it, Carl. Is there some new analysis that suddenly has come out of nowhere, that we have discovered some new principle, that the forces of gravity have been repealed upon us? I don't think so. I doubt that. I think it's wonderful that people are participating in the market that haven't before, David, but you know what I'm getting at.
No, I do, but there's going to be a lot of hedge fund executives who are going to need traditional analysis, Carl, after this is all said and done.
So the first thing I want to talk about is the actual flow analysis and what they're kind of talking about there. So basically what they're saying is, can you look at companies based on the short float or the overall float of the stock and trade based on that? Can you see the overall order flow and then trade basically adjacent to that? Making the subtle comments, trying to troll the overall Reddit community, but if anyone's laughing, it's definitely them. And then today we're also seeing a lot of these other heavily shorted companies rising to the top. The rest of the market is overall dumping, while these short squeeze stocks are pumping through the roof. In the video, he mentions Tanger Outlets, but there's also Bed Bath & Beyond, Nokia is doing very well, AMC, and a few others. All these right now potentially have a lot of room to continue to go up. We made an AMC video yesterday, and it's going from $4.50 all the way to $8. You can just click on my channel and go check that one out. But there's not really too much credit I can take. This is really just kind of luck of the draw type of stuff, especially with the short squeezes going on. But me personally, I don't trade based on short squeezes. Now, GameStop, looking at it, was it a great trade? Was it primed for this move? Actually, 100% looking back on it, it was a key mistake that I took, and I should not have bet against it. Going forward, if a stock was primed like this, would I get into it? The answer is yes. But looking at something like AMC, Bed Bath & Beyond, Tanger Outlets, those don't really have the upside for me, not as primed as GameStop was. Now, Tanger, I do like them on the long-term output. I think they're actually going to make a really nice bounce back, and their sales numbers are greatly increasing. And in the second part of this video, I kind of want to go over a few of the stocks that have the potential to keep running in this sector with this whole short squeeze going on. Bed Bath & Beyond is obviously one of the heaviest shorted stocks. Fubo TV is also being heavily shorted. We've seen a massive move from that $40 range all the way to almost $55 on the day. Absolutely insane, and that is one that no one is really talking about. Obviously, we have Nokia making that really big 5G push, AMC pumping through the roof, we have Elon Musk tweeting about them, and then we have three other stocks that are heavily shorted that no one's really talking about: iRobot, Children's Place, and Macy's, and a little bit on Dillard's. I kind of want to touch on Dillard's a little bit, but it's not shorted as much as the other three. Am I saying to play those plays? I am not saying that at all. I'm just bringing these stocks to your attention. Look into them, do your own due diligence, but trading these short squeezes is not my thing. I'm sitting on the sidelines right now because that is the safest thing to do. If you haven't seen the movie, you might not get this reference, but Michael Burry, the guy who predicted the real estate crash back in the day, he actually called for this short squeeze on GameStop. Now he's saying this is extremely dangerous and kind of reckless, which I actually 100% agree with the dude. He's making key points, and this is 100% reckless trading and kind of insanity. Also in the video, they point out a key factor with this whole Reddit trading. One, it's kind of like a cult. I'm not running anyone down. Y'all definitely won this round, so 100% kudos to you guys. But the cult trading is extremely dangerous. The gambling tendencies, thinking you're never going to lose, stocks only go up, another very, very dangerous thing to watch. Honestly, in the coming days, there's no telling how much more we could run up. One thing worth noting is Melvin Capital closed their position. So Wall Street Bets, you have officially taken down the fund. Gonna wrap it up for this video, guys. I hope you got something out of this. Comment down below if you have any questions. I will be answering those for the first 24 hours. Make sure you like, subscribe, and turn the notifications on because I'm posting videos every single day. I don't like to do these hype videos, but I had to make a video just going over this. I had a lot of questions and a lot of people saying, Tyler, what's the next short squeeze? Be looking down in the comments because I'll be commenting any of the other stocks that I think might be a short squeeze. Have a good one, guys. Namaste.